Welcome to today's Explainer. We are unpacking something called quantitative balancing. It's a radical theoretical framework that basically wants to completely rewrite the relationship between money, the government, and everyday citizens like you and me. It's a truly fascinating read that proposes a systemic reset touching on literally every aspect of how our economy functions. Whether you're a seasoned economist or just someone curious about the future of money, this framework offers a highly structured systemic overhaul, and we're going to break it all down step by step.
Right off the bat, let's ask a pretty provocative question. For centuries, our whole financial world has run on the foundation of interest and fractional reserve banking, right? But what if you just removed interest entirely? Could a banking system actually survive, let alone thrive without it? Well, the source document we're looking at today argues it absolutely can, and that doing so creates a way better, much more stable economy.
So here's our roadmap. We're going to explore this concept in 6 straightforward steps: the new social pact, the bank compromise, transparency and state role, advantages for citizens, the Nash equilibrium, and finally, the 5-year transition. Let's get right into it.
Number 1. The new social pact, the foundation of the reset.
Okay, so looking at the source, the core idea here is framed as an America First move. The primary goal? Return control of the dollar directly back to Congress and completely eliminate bank-created money. The authors describe this as a constitutional and economic reset. Basically, instead of private banks creating money out of thin air through debt, money becomes a pure public utility. The stated aim is to rebuild prosperity right from the ground up, starting with how money itself is issued.
And this brings us to a really crucial focus of the proposal: the new social pact. The document outlines a grand bargain designed to create a perfect equilibrium between the administration, the banking system, and us, the citizens. It's proposed as a true win-win-win. You see, you can't just fix one piece of the puzzle. You have to realign the incentives for all 3 of these groups at the exact same time to create a positive sum game. Let's look at exactly how it proposes doing that, starting with the banks.
Which brings us to part 2, the bank compromise, restructuring financial incentives.
I mean, why would banks ever agree to just stop charging interest? Well, look at this trade-off. It's a grand bargain for American banks. On the one hand, sure, they give up charging interest, creating fractional reserve money, and all the crazy lobbying needed to protect those privileges. But on the other side of the ledger, look at what they get. They trade that high-risk, high-stress speculative model for a super stable, utility-style setup. They drop massive regulatory burdens, they pay literally zero deposit insurance premiums, and the risk of a systemic collapse essentially vanishes.
So how do they actually make their money? It's simple: 3%. Under this proposal, banks earn a guaranteed, risk-free 3% monetization fee on the money they help create and manage. It's front-loaded, calibrated to match or even beat their current net interest margins on deposits, but with absolutely zero risk. They stay right at the heart of payments and credit, especially for Main Street, but their income becomes totally predictable.
Okay, moving to Section 3, transparency and state role, oversight and national funding.
If banks aren't policing themselves anymore, who is? The source outlines the creation of a permanent oversight body called DOJ 2. But this isn't your average, clunky regulatory agency. It's tasked with real-time, open-source auditing. Every algorithm, every audit result would be totally public. It's a radical level of transparency specifically designed so that neither the banks nor politicians can game the new system or play favorites.
And check out how the government benefits financially. By ending fractional reserve banking, the state recovers 97% of the seigniorage. That's the profit made just from the act of creating money, which right now gets captured by private banks. The document claims recovering this massive chunk of capital could let the government drastically reduce or literally eliminate distortionary federal taxes. Plus, it would directly fund huge national infrastructure projects, all while transferring the Fed's monetary powers back to the U.S. Treasury under strict congressional mandate.
Let's hit Section 4, advantages for citizens, the velocity engine.
How does all this structural change actually help you and me? Well, here are the everyday perks. First off, your bank deposits aren't just unsecured liabilities of a private bank anymore. They become 100% risk-free claims directly on the U.S. Treasury. Bank runs become mathematically impossible. Plus, because the whole system runs on flat fees instead of interest, citizens get access to zero-interest loans. Just imagine buying a house or starting a business without compounding interest, inflating the cost over decades. But wait, there's one more really crucial element to keep the economy moving.
A major critique of zero-interest money is that people might just hoard it, right? And that would completely stall the economy.
To fix this, the proposal introduces a velocity engine called the Universal Cashback Program. Funded by that recovered seigniorage we just talked about, this system credits your account within 24 hours of a transaction. But here is the catch. That cashback expires in 30 days if you don't spend it. It's literally a psychologically driven use-it-or-lose-it tool designed to force money to keep circulating fast.
And the policy is highly targeted to direct credit right into the real economy. You'd get a massive 10% cashback reward for buying essential goods or supporting American-made products. You get 5% for general retail and local small businesses, but for financial speculation, like day trading stocks or flipping real estate, 0%. The entire system is explicitly engineered to heavily favor Main Street over Wall Street and actively prevent asset bubbles.
All right, Section 5, the Nash equilibrium, locking in the system.
This is honestly the most intellectually fascinating part of the proposal. How do you stop these three distinct actors, the banks, the state, and the citizens, from trying to revert to the old ways? Well, the document claims this framework creates a completely self-reinforcing virtuous cycle. By perfectly balancing the administration, the banking system, and the citizenry, everybody gets exactly what they need the most. Cheating or defecting from the rules simply becomes irrational.
They frame this dynamic using game theory, calling it a Nash equilibrium. Basically, the banks get their safe 3% return and drop their regulatory headaches. The government operates under immutable DOJ2 oversight while securing massive funding without taxing us to death. And we, the citizens, get totally safe deposits, zero interest loans, and those lucrative cashback rewards. Because everybody's core needs are structurally guaranteed, going back to the old, volatile, interest-based system would mathematically and logically hurt their own interests. It's an equilibrium perfectly locked in by mutual benefit.
Finally, Section 6, 5-year transition, the path forward. We have to look at reality here. You can't just flip a switch on the global reserve currency overnight. So how does this actually happen? The author lays out a phased, highly predictable 5-year roadmap to avoid a market shock. Year 1 is all about passing the legislation, setting up that DOJ2 oversight, and freezing any new fractional money creation. Years 2 and 3, that's the heavy lifting. Safely converting existing deposits to Treasury claims and carefully refinancing all those old interest-bearing loans into the new zero-interest system so bank balance sheets don't collapse. By years 4 and 5, the 3% fee and the cashback program are running fully operational, and old safety nets like the FDIC can be safely phased out.
Now, anticipating legal pushback, the source explicitly grounds all of this in the U.S. Constitution, specifically Article 1, Section 8, regarding Congress's power to coin money. The document notes this is absolutely not an unconstitutional taking of property. It's a voluntary transition. Banks can choose to accept the new 3% fee structure to operate in this new framework, or they can just act strictly as pure middlemen without the power to create money.
Which brings us to our final thought today. The source material presents quantitative balancing as a pragmatic, politically neutral tool to wipe out the hidden tax of interest and completely rebuild our industrial strength. As we wrap up this explainer, I'll leave you to ponder the provocative question you're seeing now. Could this grand bargain actually work in the real world? Is it really possible to align human incentives so perfectly that an entire economy thrives completely without interest? It is an incredibly bold vision and one that challenges absolutely everything we've been taught about modern finance. Thanks for joining me for this deep dive.